Hello, everyone, and welcome to episode 66 of the Impulso podcast. Today, we're joined by special guests Dmitry and Boon, aka BP, partners from Cento Ventures. So, Cento Ventures is a venture capital firm focused on technology startups building products and services emerging from the digital transformation of promising growth markets, particularly Southeast Asia. So, joining us, we have Dimitry, who is responsible for overseeing all investment and fund activities in Southeast Asia. He formerly served as an advisor to several investment groups and corporations pursuing technology and media opportunities across developing Asia. We also have Boon, also known as BP, who leads Cento's investment strategy and deal origination efforts in addition to serving as a member of Cento's investment committee. He has over 20 years of extensive experience in venture capital and mergers and acquisition in the technology, media, and telecommunications sector. So recently, Cento Ventures has launched their Southeast Asia Tech Investment 2023 H1 report, and so we've invited Dimitry and Boon to share a little bit more on their perspectives on investment in the region. Particularly, is tech and venture capital in Southeast Asia over? Why do they still bother with Southeast Asia? And of course, how do they see venture capitals in the region deploying money in 2024?
Just for clarification, BP doesn't stand for British Petroleum.
I wish I...
Therefore, maybe you want to clarify.
Yeah, my name is Boon, but I'm usually known as BP.
So let's start the discussion.
Yeah, I think both of you have been investors in Southeast Asia for a very, very long time. And I know that, Dimitry, you had been sort of calling for this notion that winter was coming since as early as 2015. But of course, on the trajectory of the whole ecosystem of tech, venture capital, and also the large tech ecosystems in the region have evolved in very interesting ways. And I think as of last year, you saw the activities actually dropped quite a bit, which is probably in line with what we see globally, as well as what we see in China. But there's this notion from many people I talk to that they say that, okay, there isn't much to invest in Southeast Asia anymore. It's doomed. So growth stage investors have fled. Nobody looks at the secondary market anymore. What's your sense? Is winter really here? Is tech and VC doomed in this region?
There's a lot going on in that first statement. Hi, good morning. Name is Dimitry. Good to be here with you. I file an objection. I wasn't calling for winter to come. I was just a big fan of the Game of Thrones, but I was expecting it to arrive very as early as 2015 because of that little hiccup in Chinese capital markets, I think, that started the year. And it took 7 years longer than I expected. I would probably start by getting a bit more nuanced. There is more than one ecosystem in Southeast Asia. There is more than one flow of capital. So I would say we do see a slowdown of activity, quite a significant slowdown of activity coming from global investors that were once upon a time much more interested in Southeast Asia than they are now. But we don't see nearly as big a drop in activity as I expected to see and as the media would have us see in the series seed A, B, and C across Southeast Asian ecosystem. We are still doing a bit of data crunching to publish our full year report. People actually calling me now saying, hey, where is the report? Chop, chop, do it quickly. It's like, not enough time. But from what we can see from internal numbers, Series A and Series Seed in 2023 was actually at all-time high, like bar none. Series A and Series B, all-times high, except for the crazy years of 2021, 2022. So that part of the ecosystem, the one driven by Southeast Asia-focused players, seems to be doing actually just fine, despite all appearance to the contrary. But to the deeper question you're asking, Jingan, if the game is over for Southeast Asia, if there is nothing else to invest into, I really wanted to go with a casino metaphor, but haven't been inside a casino for a while, can't remember names of all the games. I'll just go with chesses and checkers. So I was coming back to Jingan's question on whether the game in Southeast Asia is over as we know it, and I was making a point that probably there are at least two games in town. There's a game of chess where founders and VCs together try to play against reality, figuring out how value chains are to be fixed. And then there's a game of checkers where stakeholders, sometimes together and sometimes against each other, try to figure out how to get to that big late stage round and how to get to those secondaries. That second game is off for now because of distinct lack of enthusiasm from late stage capital globally. BP, anything you would like to add?
Well, I guess it's useful to take a perspective, right? Having the privilege to be involved in the VC industry for 20 years, I guess if you look at the different time zone, and I think what we have in Southeast Asia the last 5 years was a bit of anomaly, right? Too much money compressed in a very short time investing. And guess now we are back to a normal where things take a bit longer, investors are a bit more deliberate. So I have issue with the word winter. I think deals are still being done, just done it at a normal pace. If you look at what VC should be investing in terms of taking their time to do duty, I think now we are back to the stage where things are a bit more, back to the norm from a historical perspective. So not really winter. I think still a lot of opportunities. Interaction with investors tell me that they are still looking at deploying. They are just a bit more cautious. So I would say cautiously optimistic, but not winter.
You use the chess and checker as kind of analogy, but I guess people from this part of the world, at least people from my ethnic background, were much more familiar with casinos. So I would very much be interested to know, how do you draw that parallel? Because casinos are also sophisticated games that have been played.
I would probably say that the baccarat tables are buzzing, but the blackjack for the moment is off the table.
That makes more sense. So the chess analogy of funders and VCs, maybe not the right word, including, or to figure out how to get on secondary markets or acquirers to take the value that they have, fostered, created, inflated, whatever. But I think an analogy for many people, the lack of growth stage capital is quite often associated with a lack of exit opportunities for them because, we invest in seed, the valuation is low, and you can think about, you might not have immediate path to see that, how this could possibly exit, but you know that, there's enough time to figure out how to do it. But for people coming in with Series C, Series D, now you look at the region, most of the public listed companies are not doing that well. And there are actually very few acquisitions happening in this part of the world. So would that change? And if that doesn't change, how does that impact the ecosystem, especially for entrepreneurs and investors?
Again, two different things going on that are frequently commingled. One is a decrease in availability of late-stage capital, and one is perceived lack of exits. Let me tackle them separately. Yes, there is less late-stage growth capital available to the ecosystem, and that impacts one particular early-stage player, an early-stage player that is oriented towards secondaries. So if the investment thesis is to build up enough velocity to attract a late-stage investor and then sell into their round, then yes, that game is temporarily over. It will start again. It's inevitable, but for now it's over. But there are other kinds of strategies in early stage, and not all of them are all about secondary sales, and some of them are distinctly opposed to raising a late-stage growth capital. And those are strategies that are oriented towards those very same exits that you say are few. Let me even split these two topics. Are there few exits in Southeast Asia? Not true. There are few very large exits in Southeast Asia that have produced credible outcomes denominated in convertible currency. So yes, IPOs that we saw last year mostly malfunctioned, with a notable exception of a couple of Malaysian ones, last couple of years. And that doesn't mean that trade sales have been few. They are just right-sized for the region. $500 million outcome in the region happens every now and again. 250 million exits happen quite frequently. 100 million exits happen all the time. The trick with those numbers is they do not allow for a mega deal and a $100 million rate. So to summarize it all, exits do happen, but one needs to be very cautious about capital trajectory, not to glide past the exit point. And if one watches out for that, this ecosystem is quite friendly. If one tries to get to $10 billion outcome, this ecosystem is extremely hostile.
So the right size you mean is 100 to 250 million kind of exits. That's what people should be expecting. That's when people raise funds in this region. And this kind of outcomes that are, in normal circumstances, as you mentioned, that we're gearing back towards the normal. This is what kind of results people should be expecting.
That's not me saying, that's Mr. Market. So a strategic that sits elsewhere and looks at Southeast Asian presence and wants to buy a footprint rather than building a footprint appears to be willing to spare 50 to 100 mil easily, 250 mil for a very good company and $500 million for an exceptional company. We only have one outlier outside of this pattern, and that was a while back with Alibaba and Lazada. And even that started with that magic $500 million number first.
Well, Lazada operated in a very, very large promise of e-commerce platform for the whole region. And it was acquired by Alibaba in 2016. And before that, they raised how much? $700 million of capital. So that was sold for 1.5 billion. I think still decent return for early investors. But I think for that, I mean, it was timing, it was the sector. And do you think that we do not have that kind of large tech outcomes in this region anymore? Because now there are still quite a number of unicorns which are waiting to, I don't know, not the right idea to go to the slaughterhouse, but what's the right idea? To go for the exit.
I think you're thinking glue factory. That's closer to the unicorn horse theme. I would stick by my assessment that a really, really exceptional outcome for Southeast Asia is $500 million to 700-800 million going forward. But obviously the trick is to get there without raising 700 million along the way. Ideal amount of capital raised for the company of that size would be 50, 60, 70 mil at most, across 3, at most 4 rounds. Again, the ecosystem math right now does not allow for mega deals, for mega rounds at all.
Let me switch to BP a little bit. So you said you have been in the ecosystem for 20 years, and the last 5 years have been the anomaly. And as a veteran, how do you feel during the last 5 years? Because you must know the market better than some of the new players which joined in the last 5 years. But quite often it's the new players which are making most of the noise.
Yeah, I guess it has been a bit of FOMO in the market in the last few years, where I think some of the investors have been pressured to deploy quickly, and hence, in terms of the due diligence, in terms of the understanding of the value chain, understanding of the opportunity, has been compressed in terms of the pace of investment. So some funds really have not been able to get conviction around it, including myself, and also I think Cento. We have been very, very cautious the last couple of years, but now we are starting to be picking up momentum. If you look at our announcement, we have just announced 3 deals. So I think this period of rapid deployment and hence having to see a bit of correction is actually now good for us, where other investors are trying to digest. We are now being a bit more aggressive in terms of our deployment.
So the patience during that period, you think will eventually pay off?
Yes, I think if we go back to the first principle, right, we just have to make sure that if you see a right deal, you understand the opportunity, and then you take your time to really, work out the capital trajectory that Dimitry mentioned, making sure that we understand what is required to have a successful exit. That takes time. You can't rush through a due diligence in 2 weeks and write a check and assume that everything will work out according to plan. So I guess now everyone is going back to the first principle, where things have to be done in the right way. So it's not fundamental. It's just basically everyone being a bit more fundamentally driven rather than fear of missing out and just latch on to any opportunity that they see out there, especially country-specific opportunities, right? If you see a country that is big market size and then you just decided to write a check just to write on that opportunity.
I do remember back in end of 2015 when I was living Rocket Internet, I attended a small forum with the first batch of Chinese investors. I mean, not really investors, but retired tech executives who were the earlier, but probably luckier ones to migrate to Singapore at that time. And they were saying that they were looking at the market. They said, okay, the market needs to go back to the business fundamentals. That was 2015. And then 2016 was probably the height of all these new business models, the boom in China. And afterwards, people find it increasingly difficult to list companies, to make business models work. And of course, I think that was also the peak of a number of sort of VC professionals. And afterwards, you see the market start to be stagnant and start to dwindle. I think a related question to this, maybe not so related, is that, I mean, when that kind of anomaly happens, and of course, it plays or impacts the psyche of entrepreneurs as a cohort quite a bit. So, both of you have been dealing with entrepreneurs, and some of them you have been interacting with or working with for a very, very long time. And how do you see that shift in the last 5 years? Because I think as investors, you probably train yourself to be disciplined. But lots of time for first time or even second time entrepreneurs, it can be quite different when you look at the situation where somebody's coming to you to say that, hey, here's a check at, I don't know, 5 times the valuation that you raised like half a year ago. It's quite difficult for them to stay sane.
Well, I'll try to start on this one. The easy way to answer this question would have been our due diligence is excellent. We just don't end up with founders who will succumb to temptation. We try, but I can think of 2 distinct cases in the last 5 years where the founder we expected to be more conservative chose a 70 million valuation over 40, chose to raise $10 million instead of 5, and then paid for it dearly and had to sell the company for parts or had to go back home or had to do whatever else that accompanies failed capital trajectory. It's incredibly painful. It causes relationships damage. It is probably one of the most tense things that one gets to experience when operating in this industry. But you know what? If a founder is good and the company they've built is solid, it's not a deadly mistake. There is always a way to reorganize the cap table, fix the alignment between stakeholders, take a down round, and live to fight another day. So I would say a lot of patience, a lot of attention, a lot of understanding, a lot of empathy is the recipe. And then founders will do what they may. We are just in the service industry trying to support them.
I just want to add that unfortunately in the VC, right, a lot of time fundraise is a scorecard for a lot of founders, right? So sometimes when they see their peers raising 20 million, it is quite difficult for them to accept that they only need 5 million to grow, because then it may reflect that they may not be as aggressive, they may not be as visionary as their peers. So everyone is looking around, and if big rounds are being raised, it creates that desire to raise bigger rounds. So it becomes race to the bottom. Everyone asking for unrealistic valuation because the function of the amount they want to raise. And that has been a challenging time for some of the entrepreneurs to really deal with that. That all the media is playing up all the big rounds, right? We are guilty of that as well. We are cheering big rounds. So to get the founders to say, look, you have to be very clear that raising a big round at a high valuation, if you cannot deliver, then like what Dimitry mentioned, it may come back and bite you. And I think some of the companies are facing that now, right? As they go out to raise their next round, their growth may not catch up with the valuation. And that's why investors are also sitting at the side, expecting the companies to deliver before they pull the trigger.
As Dimitry just mentioned, he expects that if the founder is good, even in this kind of situation where you have to clean up a mistake that you made or you and your investors collectively made, you can still find a way out of it. And that really depends on the quality of the founder. Which leads to the question of, I think I speak a lot with people who operated during the height of the boom in China. And of course, they were talking about in each sector that people invest in, there tends to be like a few hundred companies which raised the initial round. And the competition would very quickly filter out which are the ones which work, which are ones which don't work. And eventually you figure out who are the better founders, and you can observe that very quick succession. In this region, what happened is that, even the most competitive sectors, you probably have like 3 to 4 people who managed to raise a significant amount of funding. So the competitive pressure, I imagine, would be quite different. And theoretically, that would be easier for founders to resist the temptation. Or is that not true?
Probably 2 things are being conflated here. First of all, I'll again lodge a mild objection to the notion of better founder or worse founder. There is no such thing. Somebody is better at competing, somebody is better at fundraising, somebody is better at fixing their cap table if there was a mistake. But on the notion of, is Southeast Asia an easier market to operate in? No. It's not, you're just not competing against 100 well-funded rivals. You're competing against reality, against massive offline conglomerates, against undigitized economy, against unclear rules, against unpredictable regulators, against fragmented 6 market, if not to say 8 market region, and so on and so forth. That's plenty of competition. With that many friends, who needs enemies?
Yeah, but that's exactly the point, right? There's a lot more friction in the market for you to work on. And you don't have that many direct competitors that you are racing against. So theoretically, that should make it easier for you to moderate the pace and look at what's really fundamental, right?
I probably will accept your premise for the markets inside Southeast Asia that have not been too overheated. That's your Malaysia, Thailand, Philippines, and on occasion Vietnam. I'd say and rural Indonesia. I would say this point no longer holds in the hot markets, quote unquote, that up until recently were Singapore and Jakarta proper. In those two markets, enough capital supply has been formed for this point not to hold.
So it's complex. There's lots of friction, and outcome is at best $500 million. Question: why are you guys in Southeast Asia? I know for Boon, you're born here, so you have a natural sort of localizing advantage. Dimitry, you have, I'm not going to mention your passports, but you have access to probably the international markets. But so why are you here?
I don't really think I have this many countries to run to if something goes sideways. The way I decided to stay in Southeast Asia all these years ago, and it's been now 18 years, there was a basic assumption that this region will be overlooked and it will be easier to compete in, as opposed to, let's say, China or India, especially when we started Cento 2011, right? Not a lot of competition to go around. Maybe we have a chance, was the thinking. Now, full 13 years later, I would say competition is there, at least in those markets that I just mentioned, Singapore and Jakarta. But I found another reason to be here. I realized that I really do quite like complexity. And I like disentangling complex systems and figuring out how to fix them or how to help people who are trying to fix them. I'd say that is a very rich and interesting commodity that Southeast Asia provides to the world, complex and broken value chains. And for the additional bonus, I do quite like the notion, I am still only seeing it in a few of our investments, but I hope to see it more. I do quite like the notion that whoever cracks the code for regional presence in Southeast Asia will also be able to crack the code for global expansion across global emerging markets, i.e., if you figure out the commonalities between Malaysia and the Philippines, if you manage to get something to work between Jakarta and Bangkok, you know what, you can spend time, you will be successful in Colombia and Argentina, and maybe even Sri Lanka, and maybe even Kenya. Let's not go as enthusiastic as India and China, of course. So that's what keeps me going for maybe another decade, then we shall see. To the very math of your question, though, $500,000 exit size is not a problem. The problem is raising 700 million on the way there. Let's just be clear about that.
Sorry, $500,000 or $500,000?
$500,000. My pronunciation is bad. Bill with a B.
Okay.
BP, why are you here?
I know you have been to the San Francisco many times, and of course, one plausible explanation why you are still here is that it was probably, much safer to be here than be in San Francisco at the moment. That I hear from lots of tech executives who were choosing like a location of their global headquarters. They tried to come here, they went to San Francisco, then their cars got smashed, then they decided to set up in Singapore.
But you see, my view is that entrepreneurs in Southeast Asia are equally as driven, as hungry as any other tech ecosystem. And the good thing about Southeast Asia, the ecosystem is maturing. We have big platforms here hiring, training people. People are leaving the ecosystem to start their own company. So there is a talent pool there. And then on the demand side, 600 million population, young and driven to try new things. Regulatory environment is friendly for startups. There's opportunity. And back to the earlier point that Dimitry mentioned, for VC, the exit is a function of how much capital you put in. There are a couple of examples where a startup did not raise much capital, they get acquired for 125 million, 150 million. If you are invested in Series A, did one round, and you get that return, it is a good return. Right? I think people forget the notion that you do not need a unicorn to make money for the LP. You only need to be a unicorn if the company raised a lot of money, and you need to have that uplift in the valuation to just get the 3x or 5x multiple. But if you are investing in a capital efficient company, even if they get acquired for sub 500 million, I think the return profile, the portfolio construct for a particular VC can still generate the return expected from their LPs.
Outcome driven. The 5 years of anomaly, do you think it's, this is probably a huge conflicted question, but do you think it's good for the ecosystem overall, or do you think it's bad for the ecosystem overall? And of course, depending on which position you are in the ecosystem, you probably have a different perspective.
Well, maybe I think that every time, and obviously on hindsight, being able to see the kind of over 20 years of cycle, I think usually when people become very negative, the vintage 1 or 2 years after that is always a good vintage for VCs because people are pessimistic. Even entrepreneurs are realistic. They'll come to us and say, look, I understand that the valuation needs to be adjusted. I would say that it's opportunity for us, great opportunity. But because now we don't have to educate the entrepreneurs to say why your valuation should be this. They are coming and say that, yes, we understand that I can't use the 2021 valuation as a benchmark. I'm prepared to be a bit more realistic. I am prepared to let investors take longer time to do their duty. I will try to manage my cash flow in a better way that I wouldn't run out of cash after I raise this round in 6 months' time. Right. So I think in terms of opportunity, yeah, it is great when there is always a bit more negativity in the market because we are long-term investors. When people are a bit more cautious, then the brave will reap the reward. Yeah.
I would probably, again, slightly and mildly object to the notion of good and bad, but I think 7 or 8 years ago, Jinggang, we already had this conversation about a whole different anomaly. So I'll probably go right back to that conversation. Remember, we spoke about Rocket Internet, good or bad for Southeast Asia? I would say my answer remains the same. Tactically very bad and strategically quite good, so probably a net positive. What I mean by tactical? Okay, last few years of exuberance. Wrong muscle memory for a whole bunch of young investment professionals who think writing checks and doing deals is what VC is about. We have $500 million funds deployed in the period of 6 months, and then, founders retire in Singapore without seeing any result from the investment just yet. So bad across the board tactically, but strategically, these are billions of dollars that have gone into digital talent and digital build out and new value chains as opposed to just, another coal mine, another supermarket, another bank that nobody needs. So this amount of capital did propel Southeast Asia forward into the future. Inefficiently though it may have been deployed, it is still net positive because it pushed us all forward rather than backward. Same logic as I applied to developments that Rocket Internet brought to this region a decade ago. Terrible destruction of value, a whole bunch of misrepresentation, a whole bunch of European investors burnt by empty promises, a whole bunch of unqualified executives that spread across Southeast Asia and still pretend to be good. But on the net, it shook the established offline retailers. It boosted development of payments, it boosted development of logistics, and some ex-executives of Rocket I have the pleasure of talking to right now. Not too bad.
Actually, it's interesting because in 2012, in 2013, I think I see lots of people, there are a bunch from Europe, but there are also a bunch from each country. When people want to do things in tech-related stuff, not everybody is extremely inspired about funding their own stuff and also have an idea that they're really committed to. So Rocket Internet became a good training ground for many. So you're basically operating at somebody else's cost. And this is a question I get asked a lot, right? So especially from people in China saying, hey, what's your biggest reflection from Rocket Internet and time? I said, my response actually evolved over the years, but because I've been reflecting about that experience, for me personally, a couple of things that I have gained. First, obviously, is learning things at somebody else's cost. That's something I already knew. And second is making a bunch of really good friends across different continents because we're exchanging ideas with each other and stuff, especially non-Germans, because non-Germans tend to, form a better bond because it works with any kind of large setup, right? You have people from the home country, then you have everybody else becoming closer because you are sort of a different group. And the last thing is, there was this tremendous joy that when you have some money that you are just going to spend and value destruction or whatever, and that feeling was exhilarating. So, but I do see that effect on different people who are like rocket founders or MDs afterwards. Some people, I know that after that experience, they kept looking for the same drug, but they couldn't find it. Then they become depressed. I see quite a few people like that. And a few other people just learn a lesson, so try to build something on their own, adapt the same methodology. They realize that, okay, if it's the money that you need to be accounted for, and if it's a setup that you can't say that I handle my resignation and leave tomorrow, then it's a very different mindset you need to have. And of course, at Rocket, you tend to be overly aggressive, but when you build your own startups, it's a very different mindset. But I do think that, back to exactly your point, right? This is something that for each individual to figure out.
All I was saying is not good. There's a whole bunch of second-degree effects and third-degree effects, and the further away from the value destruction they get, the more positive the remote effects are. To bring things to more recent events, I mean, we all know what has become of Gojek and Tokopedia and Go2, and now, GoFar, Go Together, that's being broken into pieces. But we all have to agree their IPO and all the dancing with Indonesian flags on stage, that was pretty joyful. It's a very good framework, actually. We use it a lot. So abundance of capital accelerates flow of time. Whether it's good or bad for anybody in particular, that regardless, it just accelerates flow of time.
And obviously now things are, as you say, going back to normal, and we can't say whether there will be another surge anomaly. There will probably be, and the magnitude is probably...
We can. There always is.
Yeah, and I think for the many people I mentioned just now, it basically accelerated everything. Also the midlife crisis, right? I mean, I see people having midlife crisis in their late 20s instead of mid 40s, which maybe is a good thing, right? Because I mean, if you can get out of it, you get out of it early. So the magnitude will probably be different. And I think, and BP, you also mentioned that the vintage now is probably better. So the question is that, I mean, how do people deploy money this year, 2024?
Sure. There is a little bit of background. Let me start. I wouldn't be able to predict where money flows, but I can probably see already the three main themes for the year. The year is 1/3 in, so it's kind of becoming clear. There is definitely a theme of overreaction, overcompensation. So the very same topics that we just discussed lead a lot of players in the ecosystem to very, very rapidly and radically adjust the investment filters. What yesterday was, let's go with an approximately directionally correct unit economics and fast growth, straight into give me a profitable company or don't talk to me. So quite a bit of overcorrection there, not to mention the rush for DPI. So I think that dictates quite a few decisions, at least early this year. We'll see if folks chill later in 2024. Then there is the topic of dislocation. Again, I suggest looking at large Indonesian companies that are right now separating themselves into bits, spinning things off, or as the case of Bukalapak is launching 1,000 lifeboats, seeing what might they do that might work better than their core model. That is a reflection of what's happening across the ecosystem. In our reasonably small portfolio, on a monthly basis, now almost bi-weekly basis, we have a competitor coming by saying, buy us out, we don't want to be in this market, in this particular country. Or here is a product we developed that we do not have resources to sustain, can you please take over? So a whole lot of spin-offs, acquisitions, mergers, cleanup, market optimization. I think that would be a major topic for capital deployment this year. And then there is just generally a topic of confusion. It was really easy to think about investment themes over the course of last 5-6 years. We had such good templates. For example, Super App. Jingan, you and I discussed it so many times. It was such a good recipe. Throw a bunch of services into one app, talk a lot about cross-promotion, and Bob's your uncle. You're the winner of local services. As we all know, Indonesian FMCG market is endless. So build the flow, take a cut, and eventually you win. But the first one, look at the most recent IPOs. It was a false narrative. The second one, look at the state of Gudang Gada and Ula. And many, many more. There was another one. How about you magically throw together 10 different D2C brands and do some financial engineering? And that will, of course, be a great e-commerce company. Well, not so, not with Thrasio going bankrupt in the US. So a lot of very easy to understand false narratives have not just broken down. We long knew that they were broken. They broke down visibly and demonstrably. So now there is just not many points of consensus, and that means it's harder to build rounds and harder to build consortiums. The only alive thesis I see, still alive, is the notion of if you have strong balance sheet, you can buy things at discount, which we also know as agri-tech, also known as balance sheet traders. But even that thesis is slowly dwindling because it only works in a few very narrow spaces of commodity space. Like what works for a certain kind of fish doesn't work for a certain kind of chicken. So I would say, these three topics. There is confusion that does not allow people to focus capital in one or two spaces. There is dislocation and a lot of exchange of assets taking place. And then there is the overreaction and people trying to find shortcuts to what usually would take years. But that's my cheerful take on the market. BP, how would our peers deploy capital this year?
Well, I guess there'll be always a group of investors that will look at China, US, India, and say, okay, I'll do this for Southeast Asia, right? And they'll go out actively looking for companies that are similar to companies in this market that have just raised or just have very successful traction in the news, etc. So there always be a group of investors that will do that. I mean, you see that in coffee, we see that in certain businesses where they try to look at what's proven in established tech hub and then see whether they can replicate that in Southeast Asia. So that's one. I think another group of investors may look at, what are the trend in the policy. For example, in Malaysia, we understand that there will be a digital insurance license being issued in the middle of the year. There will be investors who try to anticipate how they can ride on that and look for maybe a bit more insurtech startup to benefit from this change of policy. So going forward, this will be a few areas where investors will start to play and focus. Obviously, we see a lot of investors talking about AI, but given Southeast Asia, I think it's tough to really have a deep tech AI play for now.
That leads to a issue about talent. So I'm not talking about entrepreneurs because I don't think that anybody can be there to accelerate that unless you have, overwhelming force like Rocket Internet earlier, or to a matter of fact, Ant Group back in 2016 to 2018. I mean, they sent like hundreds of engineers and dozens of architects to this region. And many of them, I think, are very, very qualified sort of individuals, not necessarily entrepreneurs, but at least good C-level people for companies. So that is something which I don't think individual VCs can change or influence. One factor I'm looking at is from the perspective of practitioners, right? I mean, you guys have been here for a long time. You guys are still on the front line. Do you see this region being big enough for a young generation of investors to actually take shape?
Is the market big enough to take in more young investment professionals, you ask?
Yeah.
Yes. This is a very interesting topic because BP and myself and our partner Ali, we've been looking for talent for the last half a year. There is very interesting stuff happening. I wish I could say that investment professionals are fewer, but they're more committed and more dogged, but no. A lot of very high quality investment professionals who've been fighting it out for the last decade are actually leaving the industry. To your point about heartburn, about metal fatigue, about people getting disillusioned, early onset of midlife crisis. So a lot of holes are being left in the ranks of VC firms that are otherwise perfectly capable to keep deploying and have the capital and have the story and have the stamina. So I think right now is actually a fantastic time to join our VC industry. Unfortunately, folks mostly still do it for the wrong reasons, fame and glory, and without much expectation to stay in the industry for as long as necessary, which is 10 to 15 years. But that's just me having my little middle life crisis here talking. BP, anything to add?
Oh, nothing really to add. Yeah, we do see that there's a gap in most of the VC fund. The decision makers or the experienced guys are still at junior level, are still very transient, a lot of movement there. So I think that need to be strengthened in that area. But so there's definitely room for enlarging that pool.
Do you think the issue is that because I do know quite a number of people who have been in the industry for, 3, 4, 5 years, and their frustration, I mean, for many of them to leave the industry is quite commonly that, hey, I've been working with this fund for 2.5 years, I've done 2 deals. And obviously not at the partner level, it's hard for them to build a resume per se. And I suppose this issue will persist, right? So having someone who have, 10 to 15 years commitment to industry, where how this industry will evolve probably looks very uncertain to them. It's a tough proposition.
It is tough, but what is the question there?
No, I'm just making a comment.
But allow me to... go ahead, BP, sorry.
Yeah, I just want to chime in. When we hear comment like, these where they only do 2 deals in their 2-3 years, in all investment, there's a long funnel, right? You evaluate a lot of deals, you do a lot of due diligence. In the end, you maybe end up 1 or 2. This whole cycle is actually opportunity for them to learn, for them to build up their abilities, the skill set. So I would not necessarily say that just because they do 2 deals, then it's not something that energizes them, because then you are very myopic, right? And not only that, after you do the deal, there's always opportunity to manage the portfolio, to see through the whole cycle and maybe help to exit. So if the frustration comes from doing deals, then I think they are missing the forest for the tree. Right? So I think that is kind of how I would encourage people who are not doing enough of deals, but whole aspect of the deal execution, the deal evaluation is part and parcel of the whole cycle. Even for us, partners level, each of us handle 4 to 5 deals in the investment period. That is kind of the nature of the game, right? Unless you want to adopt that approach whereby you spray and pray, where you invest 20, 30, and then that's a different scenario altogether. But in terms of doing deals, building track record, 2 deals is not something too shabby to factor in.
Well, BP is very kind. I would probably be much more extreme on this and say that it's a perfectly fine thing to say for an analyst in the industry that, hey, I haven't been given a chance to look at enough interesting businesses. I'm an analyst. That's what I do. I analyze things. So not giving me enough information, intellectual challenge is bad for me. That's a perfectly fine thing to say, again, for an analyst. But for an investment professional to say, I have taken millions of dollars that belong to other people and I have deployed them into companies and I treat that as a line in my resume, that would be a firing offense at Cento. So the measure of investment professionals should not be number of deals they've done.
Yep.
It should be a number of founders who say good things about them after they exit. And that means that 2 to 3 years is nothing. The staying period in the industry must be 5 to 7, and that's on the optimistic side. So, and there you have the illustration as to why some folks wash out of the industry sooner than others. But is it a tough proposition to your comment, Jinkan? Yes, of course. It's not a very well-paid job with lumpy outcomes that are spread across long years. And it's also about being in the support role and in the second seat to the founder who actually runs the business and running services and support infrastructure around them. So it's not for everyone.
There was this VC investor in China who gave an interview about generative AI 2 days ago, which went a bit viral. We talk about how hard it is to invest in generative AI in China, which I have had discussions about this with many friends in the industry of AI. They largely agree with his conclusion, although they did disagree with his reasoning for the conclusion. But anyway, so there was this line which lots of people were referencing during that interview. He said, in my 15 years of VC career in China, I missed ByteDance, which drove half of the returns of the whole industry in the last 10 years. I suppose he meant from 2014 till now. And that, I don't know, maybe the interviewer was being dramatic. Then he was saying that, after he said that, he went into deep thought. So not really a question, but something I threw to discussion is that, as a VC professional, you'll probably face this kind of situation, right? Sometimes you really don't know what is good. But of course, now it's probably easier because you get more time to interact with the founders so that you get a better sense. Back then, and for that particular investor, he had like half an hour session with Zhang Yimin, the founder of ByteDance. He said he found him on, and he gave half an hour because he was recommended by a friend. And do you think that, as a professional per se, investment professional per se, this kind of right-sized opportunity, this kind of normal cycle of decision making would allow you to be better to yourself psychologically throughout the career?
Oh, are you asking a mental health question?
Yes.
That's a very personal question for each investment professional. I would probably turn it slightly sideways, if I may. BP had his experiences of the same kind. Ali had his. I had mine of missing out on a fantastic deal. I used to obsess about this quite a lot in the very same terms. This was in my previous investment firm. I had a chance to look at something that became C Group at a valuation in single-digit tens of millions. A traumatic experience, and the investment decision was not structured correctly, and we did not do the deal. Kind of shaped a lot of thoughts that I have about how to run a business. Thinking about this in personal terms of I've missed the deal of a lifetime, that way madness lies. The lessons that we try to take from those experiences are best applied to how we design our VC firms. So what went wrong in that conversation? Maybe there wasn't an allocation for experimental investments into bright founders that have no idea what they're doing, which is what I'm given to understand ByteDance looked like in the very beginning, like 5 pivots a minute. Maybe too many partners were in the room and IC needs to be slimmed down. Maybe the partners were given per deal carry and fought each for their own deal and never acted as one firm. Maybe too many associates were on board who think about deals as lines in resume. What can be improved? How do you construct a better decision-making machine? I would channel this frustration to organizational design matters rather than just self-destructive thoughts and confessions on podcasts. But that's me. BP?
So you get frustrated.
All humans.
Yeah. I mean, like any investors, when you miss a good company that eventually become unicorn, you always ask yourself whether do you miss it? But then, as we all know, sometimes company change, pivot. At a point in time, when we look at the company, it could be a totally different creature. And investment, there's a bit of luck, right? When some company pivot and hit the right thing, just like Slack started as a different company altogether, become a huge success. But the investors who invest in the predecessor, did they know how big this is going to be? Right. So I think sometimes, yes, we do have regrets. All of us have regrets. I met Tokopedia when they were like very early in the 2015. I met Garena, and I met Baidu when I was in Cento Ventures. It was just like, oh, it's a Google of China. Wow, China, yeah. If I want to do that, why do I invest in US directly? So yeah, we do miss all this. I think it's important to just kind of look at the decision that you made that time. Was it sound? And if not, if there's an error in your judgment, then just pick it up and learn from that.
The best way we've managed to summarize it for internal purposes at Cento is the purpose of a VC firm is not to do deals, not to manufacture deals. The purpose of VC firm is to produce quality decisions, whether to invest or not to invest. And so every wrong decision becomes an opportunity to improve the process of making a decision for years and years and years and decades if necessary.
That's a good summary. My last question, you mentioned about that there are so many broken value chains in Southeast Asia, which make it fascinating. And I think for the last few years, you have been quite bullish about digital financial services or the value chain around transactions. So why? And what do you think can be done? And also, I think maybe partially related to the question is that lots of these opportunities are in single markets, and are these right-sized opportunities, or do you actually foresee that some of these companies would have to go to regional?
Several questions there. So on broken value chains, after looking at quite a few, some can be fixed with a simple application of digitization, right? Move your records from paper to Excel. That's the low-hanging fruit. Some need to be fixed with more than that. You need to build a marketplace where there wasn't one before. Some can only be fixed with sophisticated software as a service, with big calculations, with generative AI, what have you. But quite a few value chains in Southeast Asia we come across are fundamentally broken because of how money flows. Whether it's disruption in settlements and construction industry, whether it's a lack of working capital for e-commerce merchants, whether it's payments across borders that are delayed for 10 days, the list is endless. Don't get me started on insurance. So we don't see financial services as an industry or as a vertical for us to address, although there is much to address there. We see it as a set of tools that help build bigger, better digital companies. And to your question of single country versus multiple country, that is actually a fascinating question, because the standard go-to response to this question is every country is absolutely unique because every regulatory regime is absolutely unique. OJK in Indonesia is nothing like Bank Negara in Malaysia, and therefore the two markets could not be more different. But in practice, if you dig deep enough, you will see that infrastructure of most banks has been built by the very same few firms. I'm looking at you, IBM, I'm looking at you, Accenture. And the reference designs for payment switches underneath the pay nows of the world, the prompt pays of the world, are the very same UPI and the very same Pix, although Pix was a bit later, and the very same subsidiary of MasterCard was involved. So we are starting to realize now, 13 years in, that financial services are also this set of rails that actually allow you to go regional faster. Moreover, they do allow you to go global faster. If you figured out the breakdowns in the functioning of a bank in Malaysia or in Thailand, you actually do have a chance in Colombia. Not in the US, probably not in Japan, never in China, but in Argentina and in Chile and in Kenya and in Egypt and in South Africa, and the world is very large if you look at it from this perspective. So that's what gets us excited about financial services, not for the purposes of fixing financial industry per se, but as a set of tools and instruments, just like better connectivity, just like better data centers, just like cheaper phones that help digital company build outs, which in turn help fix those otherwise unaddressable value chains. And I'll hand this over to BP because he is a specialist in fixing unfixable value chains using very same financial services. We did make a couple of announcements on that lately.
Yeah, so maybe just to add some colors, say for example, with a lot of business model now in place, a lot of data are being generated. Maybe I just give an example of Doxa, one of the companies that we just recently invested. Traditionally, in the construction industry, there's always this dynamic between the anchor buyer, which is the main contractor, versus the supplier. In the old days, the supplier have to submit paper invoice to the finance department or construction industry. There's always errors, there's always fraud. Multiple invoice can be submitted, etc. So banks has always been finding it very difficult to finance the construction industry, especially the long tail suppliers. Now, when we talk about digital services, we don't really just restrict ourselves to just transaction, right? But here again, with this platform whereby they connect the anchor buyer with the supplier, digitizing the invoice, we can do a three-way matching. And with that data, it's very easy for us to then work with FI, financial institution, or digital banks, or any financier who want to partake in invoice financing, with the assurance that the invoice are legitimate, validated, with a pool of data that is being matched by the right buyers. So these are what we mean by digital service that we are excited, because we are seeing a traditional business model that's there the longest time in the construction section is well established. But now with the digitalization, they can introduce new opportunities for people to partake in the digital services. In the past, bank would never bother to do credit scoring for small suppliers because it's just not worth the effort. It takes up too much time, too much cost just to pass a credit committee to lend to small suppliers. But now with this platform, it lower the cost, banks can automate the whole process, and that's what we're excited. Looking at traditional business being digitized, and how do we then pick up winners in the various sector to offer financial service based off data. We are very data-driven, and we're looking for more opportunities in such arena.
And what this eventually results in is a lower mortality among small companies that participate in this value chain. Previously, you're a small contractor that breaks big rocks into small rocks, you go bankrupt every half a year, because by the time you're paid, you're no longer there. So you pay your employees lower salaries, and you use shoddy equipment, and you cut corners on regulation, and the buildings you build eventually go down in the nearest earthquake. So fixing this value chain means rather a lot to employment, to SME survival, to eventually the stability of the cities that we walk the streets of. Obviously applies outside of Singapore. Singapore is obviously perfect.
Good. I think we touched upon quite a number of issues on this hour, and thank you very much for being here this morning. And so look forward to what's happening in 2024. And I know that Dimitry has been working on the 2023 full-year investment report, which this few rounds is coming up later than previously. So I imagine the reason is that either he has too many good opportunities that he's doing due diligence on, or because otherwise it can't be explained, right? I mean, the number of deals was obviously smaller last year compared to the previous year, so that means the workload.
You'd be surprised. You'd be surprised, actually, from the first cut of data, the amount of investment in the region dropped 25%-ish, but the number of deals actually went up. Remember what I mentioned earlier? Seed and Series A, all-time high, and Series B, all-time high, minus 2020, 2021. So it's actually a lot of data to crunch, surprisingly.
So that means that there's actually more work for the team to actually do this data, because no matter how much the amount of work, the workload is the same.
So the report will come out in April. I'll try.
Yeah, look forward to that. Thanks both.
Thank you so much.